This video is for all my long-term investors who invested in growth stocks, so excited about the rally in 2020, 2021, got in. Now you're looking at your stocks that you bought at 40, 50, 60% down. What do you do? This is for you. So in this video, I'm going to walk through kind of three main buckets of information. The first being big picture, trying to put this whole thing in perspective on why these growth stocks have been hammered and what we can do. And then two, I want to talk through some actual tangible things you can do today to help take advantage of this, because long term, this is a good opportunity and you can do things structurally that make a lot of sense long term. And then third, what learnings can we take from this and how do we really prevent this from happening again in the future? So let's get into it. Number one, keeping things in perspective is massively important during these times. If you look at Shopify, this stock chart really says what everything's going through right now. Number one, here's your price, and here's maybe over the last 6 years. This stock has been massively surging all the way through recently, and over the last 4 months, literally you have down over 50% in overall value. So that's terrifying. If you're anyone of investors who are excited about technology, chances are you bought here, here, and here, and now you're bag holding with massive losses. And what do you do, right? First of all, keep this in perspective. Stocks have done this time and time again over the last 30, 50, 100 years. And this crazy thing is, on the chart, if you zoom out on Shopify, this has happened many times in the past, right? This has happened here and here, but you can't really see it because the market has recovered and the company has done what it does well, continue to grow massively over time. So zooming out, this has happened before. Number two, it's terrifying now. And three, if you hold long term and you believe in the company, nothing has changed about the thesis of Shopify. Online retail is still massively growing and people prefer online over in person. Number two, constantly new businesses are emerging with new niche applications. They all need a Shopify store. They're all using Shopify Pay. This is a massive tailwind. If you believe in that story, long-term investors should be happy. As painful as this is, you should not be concerned at all, because if you're not touching this money, hopefully for 5 to 10 years, you don't need to worry about this. You don't need to really panic because you haven't lost $1 because you haven't sold yet. Selling is the worst thing that you can do as a long-term investor that's still, you believe in the company and you believe in the thesis and the market fundamentals that are driving growth for that company. So keep that in perspective. It's happened before, you just don't see it. And yes, it's painful and scary. And every time it happens now, it feels bigger because it's a higher market drop, right? That's a natural phenomenon, the way stocks move over time. And what's caused this crash, right? It's fear. Is there a recession coming? Is inflation going to cause a massive recession? Is interest rates going to slow the growth of companies, right? In my opinion, it doesn't matter. I don't care, because eventually the turns that have happened in the market cycle are going to abate over time. And that, in my opinion, this growth story is still intact. So I should be happy because now over the next 6 months, I'm going to continue to buy these great companies and then let that time work for me till the market to sort itself out. So that's number one. Keep the big picture in play. Don't lose that. Now, what can you do in the near term? Now, you're probably terrified because you think, your net worth on Mint has maybe dropped massively. So what can you do now? Number one, I would say, is reduce your expenses as great as possible. So, trips, all these different kind of ancillary expenses that you were doing during the time when the market was really good, you felt really good about your financial position. Reduce your expenses to the bare minimum, because that's going to enable you to have more money every month to invest and capitalize on these phenomenal opportunities in great companies. Number two, increase your income. In today's world, there's so many different ways to make more income, whether it's walking dogs on a rover, whether it's starting an Amazon product, whether it's starting a YouTube channel, whatever that is for you, work on increasing your income, because again, you want more money to buy the dip, because you're not a person who's scared and just sits back and watches your money grow. And the thing that personally gives me ease during these times is every time you buy a share at these reduced prices, your percent of overall loss on that stock goes down because now you have more lower average price stocks in your portfolio. Easiest way is focus on quantity of stocks during these times. Increase your count. Try to get to groups of 100 shares of each of your favorite stocks because that's going to help you stay motivated and capture more shares. Another thing that I've done during this time to tactically take advantage of this is, number one, you could tax loss harvest. And the way I view this is essentially the way to do it successfully in these times is selling things that are down 50 or just the same percent and buying a security that's a little bit different in a different field, but it's equally as crushed, because you don't want to sell something down 60% to buy something that's only down 10%. That's counterintuitive, and you're buying stuff that isn't a great deal per se, right? Assuming you're investing in high quality companies. So really focus on essentially selling something that's down 40% and buying something that's down 50 or 60%, because you still have all that upside potential when the market rebounds over the long term, and you get massive amounts of tax loss that you can write down. And what am I writing that down against? I'm also deploying selling puts, and I have a video I'll link right here to help you understand what selling puts is at a high level. And that's essentially something that you can have that is going to provide you income to buy the dip even more, because you're saying to the market, you'll buy today's stocks in 1 year, 2 years down the line at today's prices, and you get money to make that. So it's another good opportunity to increase your income to help buy this dip. And then because you've got all these tax losses, you now won't have to pay taxes on that income that you're getting from selling puts because you took advantage of tax loss harvesting. Another quick option that you can do is you can move things from your traditional IRA into a Roth IRA and just transfer that fund. Let's say you put Shopify in, you moved it at the reduced price point, still have the same shares, and transfer them into Roth, meaning you're going to pay tax on a much lower basis on that stock, and then when it balloons, it's going to be after tax in your Roth. So it enables you to pay less tax, but still have that whole investment sitting into an after-tax account, and you're not selling, you're not doing anything, and it just enables you to move the security over at a lower tax basis than if you were to transfer at the peak into that. You're going to pay a lot more taxes on that overall. So there's some real tactical things that you can do to, again, take advantage of this, stomach the pain, and move on. And then third, how do you learn from this, right? What do you take tangibly that you can walk away with? And that's number one, is diversification is massively important. And this might have made you realize that maybe you weren't diversified enough. Maybe you were too concentrated in tech, in that space, and that's fine. As long as they're high quality companies, I'm not scared. But overall, how do you make the most money? You have a diversified portfolio. Certain assets are down, certain assets are up. You can trim from certain assets and add to the ones that are reduced. So now you should look at your portfolio long-term a little bit more strategically, and don't think, oh, it's a tech company, it's going to shoot up to the moon. Because you want to be able to reallocate and have a diversified portfolio to get very strong gains over the long term. So that's very important. And the thing that personally has saved me is over the last 5 years, I've acquired lots of properties, and real estate has done tremendously well. So my overall net worth has actually not been hit as much, and I can also maybe refinance a property to get more money out of it and put it in the stock market. It gives me opportunities and also helps me grow my wealth when I'm diversified, because real estate is such a powerful tool, and it's a means of diversification away from stocks. And then lastly, kind of looking back on it, right, is trimming what makes sense, right? Is one thing that I would do all over again, now that I've gone through this experience and I've seen stocks go up 60, 80, 100% in 6 months' time, is not be afraid of trimming assets that have done tremendously well. So, for example, Upstart is one of my companies I'm bullish on long term, and it's a company that's transforming the lending industry, helping people move away from the FICO score to a more tactical approach to approving people for lending with the same default rate. So this stock ran from $100 to $450, right? So I should have trimmed on the way up a little bit and just developed some cash, because that is not a normal movement for a stock, and there's nothing that harms me from, hey, taking a little bit of cash off that position and just letting it sit there and build a cash portfolio for dips. So really don't get caught up in the euphoria of a market, and try to transition maybe from a person who just never sells stock to, hey, this is run like crazy compared to the rest of my portfolio. Maybe I trim a couple thousand off that to just build up my cash for a downturn. Because if you learn anything about going through this investment life in the stock market, is that downturns will come. There will always be something that panics the market. A global pandemic, a war, a shortage of certain materials, right? These are shocks that happen countless times because, our world is moving into a more unstable environment. So this is something that you need to understand is coming. You can be smart and more equipped to tackle these situations, and just help keep things in perspective is so important during this time. And hopefully this video helped you put things in perspective. And the thing that always gives me, one last point, is something that always gives me confidence is that when a certain stock goes down, is it the only stock in its associated sector, or is the whole sector going down? And in this case, all of massive growth companies are getting crushed. And that gives me more confidence, meaning that there's going to be deals that are emerging here. It's not just one company and all the rest are going up, meaning that one company is making poor business decisions and it's not winning in its market space. Everything is now 50, 60% down. And in that situations, those when I have more confidence that everyone's losing money, and therefore could be great opportunities coming in this particular sector or market. So keep things in perspective, and hopefully you stomach this pain, because I know it hurts. And believe me, hopefully these tips I walked you through today will, help you get through this and actually capitalize on these opportunities, because as painful as they are, they can help springboard you into the next level of generational wealth that you're trying to build for yourself and your future family. So thanks for listening to Live to Learn. If you like this kind of content, feel free to like, subscribe. Also, just leave your comments. I'd love to engage with you on anything related to investing and finances. Thanks for tuning in. Take care.